10-year note yields settle at their lowest in over a year on the week. So you got to go back to January of 2018, the last time we settled on a Friday this low. Basically what we're seeing here in 10 years is better buyers into the weekend, a lot of uncertainty. We had the State of the Union, not so great news about China and possibly trade and whatnot, and the market really seemingly bounces from the high yield of the week down to the low yield of the week very quickly. And right now we're just kind of waiting to see if we can break out of that range. I mean, the market has been in this roughly, we'll call it 260 to 280 range, spending a lot of that time at 270, 275, which is right in the midpoint. And it's been getting very comfortable there, but now we're sort of testing the outer limits to the downside. And that could be a bit of a problem as we move forward if we see yields continue to creep lower. And I think that if you look at breaking out of the range, you anticipate volatility might be starting to get a little bit of a bid. Now it has firmed and it hasn't gone down a whole lot over the last week or so, but we are still hovering right on that 14-day moving average, which is trending lower. And we're not seeing any sort of angst, no fear priced into the market yet. And I think if we break out of that downside range, see a yield print below 260, we'll probably start to see that volatility turn the other way and start to bid up. Recall when we broke out of the range back in November and then again in January, we saw volatility trading at its highs. We're much lower than those levels now, and I think that right now the market's kind of thinking we're going to stay contained likely until the end of March, when we get the Brexit announcement. So right now the market seems very comfortable in that range despite the fact that we are pushing lower. So volatility lower, we're seeing yields go lower. What do we have ahead? Well, we've got inflation data next week. We'll get CPI and PPI along with retail sales. So that could give us something to sink our teeth into. Likewise, we'll continue to follow closely all the going-ons between the U.S. and China and any trade updates that we could get. It doesn't look like things are all that positive right now, but things can change very quickly in that arena. Likewise, we are also going to be looking ahead at any sort of Brexit news. And now Brexit has been on everybody's map since June of 2016, but more recently since we've had a lot of UK political mumbles and we've seen what's happened between hard and soft Brexit expectations. While the British Parliament could see a vote next week, it's unlikely that they'll get it to, they're talking about kicking it down the road a ways. Why, I don't know, because the time is not certainly getting, is not on their side and it's not going to help. But that is going to be, I think, really the creme de la creme of the entire macro market structure. How does the market react to whatever type of Brexit there is on March 30th, March 29th being the day that it goes into play. So right now, I think all markets are sort of hinging on that. Positioning is seeing maybe risk coming off the table a little bit. That's why we're seeing yields go lower. That's why we're seeing gold go higher. Equities, while they are in a massive still upshoot trend, are starting to pull back as well. So right now that could be part of the game. We do have a few things in between now and March 29th, but I think from a macro level, that is what's really driving the market. Fed policy right now leaning towards more dovishness. You're seeing that basically from all central banks now. More of a dovish outlook, at least as far as raising rates and as far as cutting back the purchasing of assets, which right now most central banks are not doing, but they're not going to be taking them off their balance sheets either. So I look for the 10-year to probably continue to trade the data, earnings and whatnot, but you take a step back, if we break out of that range, that 260 low yield, that's going to create a bit of a buzz. Positioning reports are starting to come back out since the government closure. However, we're only caught up to January 1st of this year, so we still have about 4 to 5 weeks of position reports to catch up on, which we will get over the coming weeks. It will be interesting to see that massive short base in the leveraged fund community, how they're holding on to their 10 years, or if they're holding on to their 10-year shorts, because that could have been one of the drivers that pushed the market. But if it wasn't, why aren't we seeing them come in now as we push to these lower yields? It will be interesting to see exactly how they played this out, because right now they could still be holding on to those as we've been trading the range. We haven't seen them reload and get short again if they did unwind. So right now the market hovering on the lows, volatility lower, but we've got a new week coming up with inflation data, more on China and more Brexit.